I have outperformed the SPY throughout my investing journey, and I've just created a free Telegram group to share my investment thesis and companies that are worth looking at. Telegram group link is in the pinned comment. See you inside. On today's episode, we will be looking at the deep dive of Netflix to see if it is a buy or sell. Netflix earns mainly through monthly subscriptions and advertising. It provides customers with access to a large library of movies, TV shows, and games. Revenue is reinvested into producing and licensing content. Better content attracts and retains more viewers, increasing subscriptions, engagement, and revenue, which can then fund even more content. What about its financials? Netflix shows strong and consistent financial growth. Revenue increased from $31.6 billion in 2022 to $45.2 billion in 2025, while net profit rose from $4.5 billion to $11.0 billion. TTM figures are even stronger at $48.4 billion revenue and $13.6 billion net profit, showing that Netflix is not only growing sales, but also becoming increasingly profitable. Netflix's cash generation has improved significantly. Operating cash flow rose from $2.0 billion in 2022 to $10.1 billion in 2025, while free cash flow increased from $1.6 billion to $9.5 billion. TTM figures reached $12.0 billion operating cash flow and $11.2 billion free cash flow, showing Netflix is generating much stronger cash from its business. Netflix's revenue grew from $31.6 billion in 2022 to $45.2 billion in 2025, while accounts receivable increased from $989 million to $2.0 billion. Although receivables grew faster, they remain small relative to total revenue. This suggests Netflix is still collecting most of its revenue efficiently, with no major concern from receivables. What about the financial ratios? Netflix shows strong financial health. ROE of 49.17% and ROIC of 23.99% indicate efficient use of shareholder and invested capital. Debt to EBITDA of 0.41 suggests very manageable debt, while a 1.14 current ratio indicates Netflix can cover its short-term obligations. Overall, profitability, debt management, and liquidity appear healthy. What about the market share? Netflix is the clear market leader, holding 27.1% of global paid streaming subscribers. This is significantly ahead of Prime Video at 16.6% and Max at 11.7%. Netflix's large lead demonstrates its strong global scale, brand recognition, and competitive position in the streaming industry. So who are the clients of Netflix? Netflix serves two main customer groups. Its core clients are individual viewers and households, B2C, who generate subscription revenue. Its second group is advertisers and businesses, B2B, that pay Netflix to reach viewers through ads. This creates two revenue streams, subscriptions and advertising. What about the competitive advantage? Netflix has a wide economic moat, supported by its globally recognized brand, massive scale, strong customer base, and valuable original content. Its scale lowers costs, while personalization and recommendations improve customer retention. High content and technology investment also creates barriers for new competitors, strengthening Netflix's long-term competitive position. What is the intrinsic value then? Based on the DCF model, Netflix's estimated intrinsic value is $94.96 per share, compared with a market price of $73.66. This means the stock is trading about 22.4% below its estimated fair value, suggesting it may be undervalued with potential upside if the DCF assumptions are achieved. So who are the competitors? Netflix appears financially stronger than its streaming peers on profitability and capital efficiency. Its 49.17% ROE and 23.99% ROIC outperform Amazon and HBO Max. While Amazon generates far greater total revenue and profit due to its diversified businesses, Netflix demonstrates stronger returns from the capital invested in its business. How is the stock performance over the years? Over the past year, Netflix has significantly underperformed its competitors, falling about 39.8%, while Amazon gained 21.3%, and Max, which took over by WBD, surged 145.1%. Despite Netflix's strong fundamentals, this shows weak recent market sentiment. Combined with the DCF valuation, the price decline could indicate a potential opportunity if Netflix's fundamentals remain strong. Over the 5-year period, Netflix gained approximately 41.5%, showing positive long-term returns despite significant volatility. Amazon performed better at plus 63.2%, while WBD declined 3.2%. Netflix's recovery from earlier declines shows improving investor confidence, although its 5-year performance still trails Amazon. Since its IPO, Netflix has delivered exceptional long-term returns of roughly 63,648%, significantly outperforming Amazon's 29,383%. This highlights Netflix's transformation from a small streaming business into a global entertainment leader and demonstrates the enormous value created for long-term shareholders. So, where should we add the stock? Netflix is currently trading around $73.77, close to a key historical support level near 68.82. This area previously acted as resistance before the major rally, making it an important level to watch. If support holds, it could provide a base for recovery. If it breaks, the next major support is around $47.76. So, any recent acquisition by Netflix? Netflix agreed to acquire Warner Bros. Discovery in December 2025 for about $82.7 billion enterprise value. However, after Paramount Skydance submitted a higher offer, Netflix chose not to raise its bid and walked away. This demonstrates disciplined capital allocation, as management prioritized shareholder returns rather than overpaying for an acquisition. What is the future catalyst and risks? Netflix has several strong growth catalysts, including advertising expansion, better monetization of its global audience, and continued investment in content, live programming, and games. Key risks include intense competition, high content costs, and subscriber slowdown or pricing pressure. Overall, execution on growth and retention will be critical. So did I buy Netflix shares? Yes, I did! Bought it at 3rd of August, which once again is a non-financial advice but just sharing as an educational post. Feel free to join the free Telegram group. Link is at comment pinned.